Hey, I'm Richard Pemberton, and today we're going to talk about something your bank really doesn't want you to understand: how they create money out of literally nothing. Here's a question most people have never thought about. When you deposit $1,000 into your bank account, where does that money go? Most people assume the bank puts it in a vault somewhere, locks it up, keeps it safe until you need it back. That's not what happens, not even close. What actually happens is one of the most fascinating and quietly controversial systems in all of modern finance. A system that allows banks to create money that didn't exist before. A system that every major economy in the world runs on. A system that almost nobody, including most people with college degrees, actually understands. By the end of this video, you'll understand exactly how banks create money, why the system exists, what it means for your savings, for inflation, for the economy, and why some very serious people think it's one of the most important things happening in the financial world right now that nobody talks about. Let's start at the very beginning. What is money, really? This sounds like a simple question. It isn't. Money is not gold. The United States left the gold standard in 1971. Since then, the dollar has not been backed by anything physical. It is backed by trust, faith, the collective agreement of hundreds of millions of people that these pieces of paper and these digital numbers are worth something. That's it. Money is a shared belief, an agreement. And when you understand that, the idea that banks can create money starts to seem a lot less crazy. Because if money is just an agreement, then creating more of it is just creating more agreements. Here's where it gets interesting. There are two main types of money in the modern economy. The first type is called central bank money, or base money. This is the money created by the Federal Reserve, physical cash, the bills in your wallet, the electronic reserves that banks hold at the Fed. This is what most people think of when they think of real money. The second type, and this is the one almost nobody thinks about, is commercial bank money. This is money created by regular banks, JP Morgan Chase, Bank of America, your local credit union. And this type of money accounts for the vast majority of all money in existence. In the United States, roughly 90 to 95% of all money in circulation was not created by the Federal Reserve. It was created by commercial banks. How? Through a process called fractional reserve banking. And understanding this process will change how you see every bank, every loan, and every dollar in your account. Let's walk through exactly how it works. For example, you deposit $1,000 in your bank. Let's call it First National Bank. First National is required by regulators to keep a certain percentage of deposits on hand, called the reserve requirement. Historically, in the United States, this was around 10%. So First National keeps $100 in reserve. For example, what does it do with the other $900? It lends it out. A neighbor down the street, let's call him Tom, comes in and takes out a $900 loan to fix his roof. First National creates a new account for Tom and deposits $900 into it. Stop right there. Before Tom walked into that bank, the $900 did not exist anywhere. First National didn't take it out of a vault. It didn't transfer it from another account. It typed $900 into a computer, and those $900 came into existence. You still have your $1,000 in your account. Tom now has $900 in his account. The total amount of money in the system just went from $1,000 to $1,900. Use it, $900 was created, out of nothing, through a loan. But it doesn't stop there. Tom pays his roofer. The roofer deposits the $900 into her bank. Let's call it Second National Bank. Second National keeps 10%, $90, in reserve. It lends out the remaining $810. That $810 gets deposited somewhere else. That bank keeps 10%, lends out the rest. And on and on and on. $1,000 of real deposited money has now generated, through this chain of lending and depositing, up to $10,000 in total money in the economy. This is called the money multiplier effect. $1 base money can create up to $10 or more of commercial bank money through the lending process. Your $1,000 deposit didn't just sit in a vault. It became the foundation for $10,000 of economic activity. Now let's be more precise about what's actually happening. When a bank makes a loan, it doesn't move existing money from one place to another. It creates a new deposit. The Bank of England, one of the most respected central banks in the world, published a paper in 2014 that stated this explicitly. I want to read you the key quote from that paper because it's remarkable coming from an official central bank. They wrote, and I'm paraphrasing closely, that the majority of money in the modern economy is created not by the central bank printing notes, but by commercial banks making loans. Whenever a bank makes a loan, it simultaneously creates a matching deposit in the borrower's bank account, thereby creating new money. The Bank of England, saying clearly, banks create money when they make loans. This is not a conspiracy theory. This is not fringe economics. This is the official stated position of one of the oldest and most respected financial institutions on the planet. Money is created when banks lend, and it is destroyed when loans are repaid. When Tom pays back his $900 loan, that $900 disappears. It goes back to wherever it came from, which is nowhere. It ceases to exist. Money is constantly being created and destroyed through the lending cycle, every single day. Now let's talk about where the Federal Reserve fits into all of this. The Fed is what's called the central bank. It sits above commercial banks. It has powers that commercial banks don't. The Fed can create base money, the reserve money that banks hold. It does this in several ways. It can print physical cash, though this is a small part of the picture. More importantly, it can create electronic reserves by buying assets from banks, a process called quantitative easing. When the Fed buys a bond from JP Morgan Chase, it doesn't write a check. It simply increases the number in JP Morgan's reserve account at the Fed. New money appears, created by a computer entry. This is the same basic mechanism as commercial bank lending, just at a different level of the system. The Fed also sets the interest rate, specifically the federal funds rate, which is the rate at which banks lend reserves to each other overnight. This rate influences every other interest rate in the economy, your mortgage rate, your car loan rate, your savings account rate. All of them trace back to the federal funds rate. By raising or lowering this rate, the Fed makes borrowing more expensive or cheaper, which slows down or speeds up the creation of money throughout the economy. When the Fed raises rates, borrowing becomes more expensive. Banks make fewer loans. Less money is created. The economy cools. When the Fed cuts rates, borrowing becomes cheaper. Banks make more loans. More money is created. The economy heats up. The Fed is essentially the dial that controls how fast the money creation machine runs. Now, let's talk about what happens when the system goes wrong. Because it does go wrong, sometimes catastrophically. 2008. The financial crisis of 2008 was, at its core, a story about money creation going too far, too fast, in the wrong places. Banks had created enormous amounts of money through mortgage loans, not just regular mortgages, but increasingly exotic, increasingly risky mortgages. Loans given to people who couldn't afford them, packaged into securities, sold to investors, leveraged many times over. The amount of money created through this process was staggering. The financial system had inflated itself to many times the size of the underlying real economy. Then the default started. People stopped paying their mortgages. The loans went bad. And when loans go bad, remember, money is destroyed. Not just the original deposit, the entire chain of money creation that was built on top of it. This is called a deflationary spiral. Money destruction feeds on itself. Banks stop lending. Less money is created. The economy contracts. More defaults. More money destruction. Repeat. The Federal Reserve's response was to step in and create money at an unprecedented scale to replace the money that was being destroyed. Quantitative easing. Trillions of dollars, created by computer entries at the Fed. It worked in the sense that it stopped the collapse, but it also demonstrated just how fragile and how manufactured the entire system is. Money is not a natural resource. It is not discovered or grown or mined in finite quantities. It is created and destroyed continuously by institutions, both public and private, following rules and incentives that most people never think about. Let's talk about what this means for inflation. If banks can create money, why isn't there constant runaway inflation? If money can appear from nowhere, why doesn't it just keep appearing until it's worthless? The answer is that money creation is constrained by the reserve requirement, by capital requirements, by the interest rate, by demand for loans, and by the willingness of people to borrow. When the economy is growing, people borrow more. Money creation accelerates. If it accelerates faster than the production of real goods and services, inflation results. More money chasing the same amount of stuff. When the economy is contracting, people borrow less. Money creation slows. In severe contractions, money is actually destroyed faster than it's created, leading to deflation, which is in many ways more dangerous than inflation. The entire art of central banking, the entire job of the Federal Reserve, is to manage this process. Keep money creation growing at roughly the same pace as economic growth, 2% inflation, not too hot, not too cold. It sounds simple. It is extraordinarily difficult in practice. Because the Fed doesn't directly control how much money commercial banks create, it only controls the conditions under which they create it, the interest rate, the reserve requirements, the regulatory environment. It's like trying to steer a ship by adjusting the temperature of the water around it. You can influence the direction, you can't directly control it. Now let's talk about something that most people find deeply uncomfortable when they first understand it. If banks create money when they make loans, then the money you borrowed for your house, your car, your student loans, that money was created specifically for you at the moment you signed the loan documents. It didn't come from someone else's savings. It didn't come from a vault. It was created, new, just for that transaction. And yet, you have to pay it back, with interest. The principal, the original amount, will be destroyed when you repay it, back to nothing, as if it never existed. But the interest? The bank gets to keep the interest, which is real money, created from the repayment of manufactured money. This is the fundamental business model of banking. Create money, charge interest on it, keep the interest, repeat. To be clear, this isn't fraud. It's not illegal. It's the designed function of the banking system. Banks provide a service. They allocate capital to people and businesses that need it. They take on the risk of default. They provide the infrastructure of modern economic life. The interest they charge is payment for those services. But understanding the mechanism changes how you see the relationship between borrowers and banks. You are not borrowing someone else's savings. You are borrowing money that didn't exist until you asked for it. And the interest you pay on that manufactured money is very, very real. Let's talk about what this means for you personally. Understanding how money is created has several practical implications. First, your savings account is not what you think it is. When you deposit money in a bank, you are not storing your money there. You are lending it to the bank. The bank owes you that money back, but your actual dollars are gone. They've been lent out, multiplied, circulated through the economy. What you have is a claim against the bank, an IOU. This is why bank runs are so dangerous. If everyone went to the bank at the same time to withdraw their deposits, the bank couldn't pay. There's not enough base money in existence to cover all deposits simultaneously. That's the fundamental nature of fractional reserve banking. The FDIC, the Federal Deposit Insurance Corporation, exists precisely because of this. If your bank fails, the FDIC guarantees up to $250,000 per depositor per bank. This guarantee is what prevents bank runs under normal circumstances. People don't rush to withdraw because they know the government has their back. But understand what you actually have in your bank account: a legal claim, an IOU, not physical money sitting in a vault with your name on it. Second, interest rates affect your wealth more than most people realize. When the Fed raises interest rates, it's not just making mortgages more expensive. It's slowing down the entire money creation machine. Less money in the economy means asset prices tend to fall. Your house, your stocks, your investments, all affected by this one lever. When the Fed cuts rates, the opposite. More money creation. Asset prices tend to rise. Inflation tends to follow. This is why financial markets watch every single Fed meeting with obsessive attention. The Fed's decisions about interest rates don't just affect borrowing costs. They affect the entire volume of money in the economy. And money volume affects everything. Third, debt is the engine of economic growth, and this has implications. In a fractional reserve system, economic growth requires debt growth. More money in the economy means more loans must be outstanding. More loans means more debt. The entire system runs on debt: corporate debt, government debt, personal debt, mortgage debt, student loan debt. All of it is, in a very real sense, the fuel that keeps the money supply growing. This creates a structural incentive toward debt that some economists find deeply troubling. A system that requires ever-increasing debt to function is a system that can become unstable if that debt growth ever stops. 2008 was a preview of what happens when the debt machine stops. The next time it stops, if there is a next time, could be different. Or it could be the same. Nobody knows. Let's talk about some alternatives, because some very serious people have proposed very different systems. One alternative is called full reserve banking, or 100% reserve banking. In this system, banks would be required to keep 100% of deposits in reserve. They could not lend out money they don't actually have.
To make loans, they would need to borrow money from depositors explicitly, with depositors knowingly choosing to make their savings unavailable for a period of time. In this system, money creation through lending would be impossible. The money supply would be controlled entirely by the central bank. Banks would be pure intermediaries, connecting savers to borrowers, rather than creators of money themselves. This system was seriously proposed after the Great Depression by some of the leading economists of the time, including Irving Fisher and Milton Friedman. The Chicago Plan, as it was called, argued that the banking system's ability to create money was a primary cause of economic instability. The International Monetary Fund published a paper in 2012 revisiting the Chicago Plan and found that it had significant theoretical merit. More stable, less prone to banking crises, less debt dependent. It has never been implemented. The banking industry has always opposed it vigorously. Banks make most of their money from the ability to lend out deposits. Full reserve banking would eliminate that business model. Another alternative, and one that's very much in the news, is central bank digital currencies, or CBDCs. The idea of a digital dollar issued directly by the Federal Reserve that citizens could hold directly without going through commercial banks. In a CBDC world, you wouldn't need a bank account to have digital money. You'd have an account directly at the Fed. Banks would lose their privileged role as creators and distributors of money. Proponents say this would make the financial system more stable, more efficient, and more equitable. Critics, including many privacy advocates and some economists, worry about the surveillance implications and the concentration of financial power in government hands. Bitcoin and other cryptocurrencies can be understood in part as a response to this entire system. A fixed supply of money, no central bank, no commercial bank money creation, no fractional reserve. The rules written in code and mathematically enforced. Whether that alternative is better or worse depends on what you value: growth and flexibility, or stability and certainty. The debate is genuine and unresolved. Let's bring it all together. Banks create money. This is not a secret. It is not a conspiracy. It is the stated, documented, official mechanism of the modern monetary system. When you take out a loan, money is created. When you pay it back, money is destroyed. The total amount of money in the economy at any given moment is the sum of all outstanding loans in the system. The Federal Reserve influences this process by setting interest rates and reserve requirements, but it does not directly control how much money commercial banks create. This system has enabled extraordinary economic growth over the past century. It has also created recurring cycles of boom and bust, inflation and deflation, crisis and recovery. It is not the only possible system, but it is the system we have, and understanding it, really understanding it, changes how you see money, debt, banks, inflation, and economic policy. Most people go through their entire lives using money every day without ever understanding where it comes from. Now you do. What you do with that knowledge is up to you. If this video changed how you think about money, hit the like button. It genuinely helps more people find this content. Subscribe, because next week we're talking about the Roth IRA, the account that lets your money grow completely tax-free. Why it might be the single best financial tool available to